All right, so Bitcoin's down 12% in a week. Gold just had its worst day since 1983. And silver, well, its worst day in 46 years. And everyone, I mean, everyone is saying the same thing right now. Kevin Warsh is a hawk, crypto's dead, the bull runs over. But I disagree. When you actually dig into what's happening, not just the headlines, not the Twitter X panic, but the actual economic and political forces at play, you start to see a different picture. There are 5 specific reasons I want to bring you today as to why I believe the United States government will likely need to inject liquidity into the economy over the next 12 months. These aren't speculative, they're based on national security requirements, political realities, and existing policy commitments. And when you understand these forces, the Warsh nomination starts to look very different than the market's initial reaction suggested. And I actually think the market's gonna pump much faster than in just the next 12 months. I think it's coming soon. So let us break it down. Now, the first reason has to do with artificial intelligence and national security. The United States, we know, is in direct competition with China for AI supremacy. And according to statements from the highest levels of government, this isn't just about economic advantage. It's being treated as a matter of national security. Let me show you what officials are actually saying about it, because it connects to our current market conditions and what we can expect coming soon. We hear from Trump's energy secretary comparing this AI race against China to a modern-day Manhattan Project. And for context, the Manhattan Project was the race to develop nuclear weapons during World War II. When government officials use that comparison, they're signaling this is existential, not just business competition. And Matt Pottinger, the former Deputy National Security Advisor, stated, AI will likely become the most powerful and strategic technology in history. Nations that are first to build AI systems will gain a strategic advantage. And Vice President Vance said in February, authoritarian regimes have stolen and used AI to strengthen their military, their intelligence, and surveillance capabilities. This administration will block such efforts. Full stop, he said. So what does this mean in practical terms? Well, we know the administration announced the Stargate project, a commitment to invest $500 billion in AI infrastructure over the next 5 years. That works out to roughly $100 billion per year. And to put that into perspective for you, that's more than the annual GDP of most countries. We're talking about building data centers, chip manufacturing plants, and massive energy infrastructure. We see that states like Wyoming and Texas are already building additional power grid capacity, specifically for AI data centers, which require enormous amounts of electricity. Now, here is how this connects to monetary policy, the market, Bitcoin, and your portfolio. Okay, I'm getting to it. Because large-scale infrastructure projects of this magnitude require access to capital. And the cost of that capital is directly tied, you guessed it, to interest rates. Because tech companies building data centers, they need to finance their construction. Chip manufacturers need capital for fabrication plants. Energy projects require long-term financing. Venture capital funding AI startups depend on the overall cost of money. So you see they're connected. So if the Federal Reserve maintains interest rates at 3.5 or 4%, while China over here provides state-backed financing at lower rates to their AI sectors, we're creating a structural disadvantage for American companies. And you know, Trump and the whole presidential administration cannot afford that. And we also know China isn't slowing down their AI development. They're investing heavily through state-backed programs, and their companies don't face the same capital constraints as American firms operating in a higher interest rate environment. So let us go back to Kevin Warsh, okay? Because Kevin Warsh has a background in both finance and technology investment. He's invested in AI companies and understands the connection between monetary policy and technological development. So when he talks about wanting a productivity boom, that requires investment. And investment happens more readily when the cost of capital is lower. So that's the first piece of this puzzle I want to put together for us today. Now, the second reason is more political, and it involves electoral politics and campaign promises. What do I mean? Well, President Trump has made multiple public statements about sending Americans a $2,000 payment funded by tariff revenue. In November last year, 2025, a dividend of at least $2,000 a person will be paid to everyone, he said, on his Truth Social account. And in December, he said, we're going to be giving back refunds out of the tariffs, dividends to the people, he said. And the timing he specified would be around the middle of next year, which is this year, this summer of 2026. And what's interesting is that this timing aligns with the 2026 midterm elections scheduled for November 3rd. All 435 House seats and the 35 Senate seats will be on the ballot. Republicans right now currently hold a 219 to 213 majority in the House. That's a margin of just 6 seats. And historically, the president's party tends to lose seats during midterm elections. In 2018, during Trump's first term, Republicans lost 41 House seats. If Republicans lose control of either chamber, it fundamentally changes the political dynamics for the remainder of the term of his term. Legislative priorities become harder to advance and oversight increases. So there's clear political incentive to deliver economic benefits before the election. But there is a mathematical challenge worth getting into. That is, tariff revenue in 2025 was approximately $300 billion. So sending $2,000 to roughly 150 million Americans would cost between $300 and $600 billion, which represents most or all of the tariff revenue. Now, of course, there's going to be stipulations on who qualifies, right? So we have to take that into account too. But what's interesting here is that White House economic advisor Kevin Hassett addressed this spot on, noting that the deficit has improved by $600 billion compared to the previous year, which he suggests, and this is the part that you have to pay attention to, this creates room, he said, for such a program of paying people $2,000 each from the tariff revenue. Now, this suggests funding would come through government borrowing rather than exclusively from tariff revenue. And here's where interest rates become relevant to this conversation. Because when the government borrows money, it pays interest on that debt. And the cost of borrowing is directly tied to the Federal Reserve's interest rate policy, right? Which means higher interest rates equal higher borrowing costs for the government. Lower rates mean lower borrowing costs for the government. So if you're planning to borrow several $100 billion and distribute it before an election, you'd prefer to do so in a lower interest rate environment. This creates alignment between political objectives and monetary policy preferences. This administration has an incentive to see interest rates come down, is what it means. Kevin Warsh would be aware of these political realities. And while Fed chairs are meant to operate independently, they also operate within a political context. And they are Americans too. So it's also in their best interest to make sure America remains first in this AI race for national security reasons, which bring us to who Kevin Warsh actually is. Who is he? Well, Warsh has a documented history of investing in cryptocurrency-related companies. He's backed Bitwise Asset Management, which operates a major crypto index fund. He invested in Basis, an algorithmic stablecoin project, and he has served as an advisor to Electric Capital, a venture capital firm focused on crypto and blockchain. These aren't just passive investments. They indicate engagement with the sector at a time when many traditional finance figures were dismissive of crypto entirely. And in May last year, he even stated, "Bitcoin does not make me nervous," he said. "I think it can often be a very good policeman for policy. The policeman for policy comment is interesting. It suggests Bitcoin serves as a market-based check on Federal Reserve decisions, which is a more sophisticated view than simply dismissing it. But what's more relevant for the broader market discussion are his recent comments about interest rates. In July last year, he told Fox News, interest rates should be lower. If you can cut interest rates credibly, you can put the economy in the next degree of acceleration. Now, that's a fairly dovish position if you ask me, advocating for lower interest rates. And in the same period of time, he told CNBC that the Fed's hesitancy to cut rates is actually quite a mark against them. We need regime change, he said. Now, Warsh does have a more hawkish history, keyword, when it comes to the Fed's balance sheet. He's been critical of excessive quantitative easing and has argued for reducing the size of the Fed's holdings. His actual framework appears to be as follows. Reduce the balance sheet to remove market distortion, while simultaneously cutting short-term interest rates to support growth. So the argument here is that you can have both fiscal discipline through balance sheet reduction, but monetary accommodation through lower rates. So whether this framework works in practice is debatable, but it's not simply hawkish or dovish. It's a specific approach to monetary policy. The relevant point for markets is that Warsh has explicitly called for lower interest rates in recent statements, and he's done so while knowing he was being considered for this role. Which brings us to our fourth factor, which involves regulatory developments that are happening right now. This week, there's a meeting at the White House bringing together representatives from major banks like JP Morgan and Bank of America, and cryptocurrency companies like Circle and Paxos and various policymakers. The focus is on developing a framework for stablecoin regulation. And for context, stablecoins like USDC and USDT represent hundreds of billions of dollars in the cryptocurrency ecosystem. They function as a primary way to move US dollars value within crypto markets. And currently, there's regulatory uncertainty around their status. And this White House meeting is aimed at establishing clear rules. The framework being discussed reportedly includes federal licensing requirements for stablecoin issuers, reserve requirements, mandating one-to-one backing with U.S. Treasuries, prohibition on interest payments to stablecoin holders, banking access for properly licensed stablecoin companies, and if implemented, this would provide the regulatory clarity that both banks and crypto companies have been seeking. Beyond stablecoins, there's also legislative movement in the Senate. The Fit for the 21st Century Act, or similar comprehensive crypto legislation, is advancing through committee. This bill addresses several long-standing regulatory questions, clarifying which agency, the SEC or the CFTC, has jurisdiction over different types of digital assets, establishing a legal framework for cryptocurrency exchanges to operate within, enabling banks to offer crypto custody services, providing tax treatment clarity for smaller transactions. The importance of this is structural rather than immediate. And right now, US-based crypto companies operate with regulatory uncertainty. Many actually have contingency plans to relocate if regulations become unfavorable, which would be very bad for the US since the US also has declared they want to be the crypto capital of the world. So they're not going to want to push away crypto founders and crypto companies. So clear regulation allows these companies to make long-term commitments to US operation. It allows them to hire domestically and build infrastructure with confidence. It also potentially unlocks institutional capital that has been sidelined due to compliance concerns. But now, let us connect the dots. Let us connect this back to Kevin Warsh. This is where his background is relevant because his investments in crypto companies suggest familiarity with the sector, experience with the sector. And as Fed chair, he would participate in interagency discussions about financial regulation. A Fed chair who understands crypto and has invested in it is likely to approach regulation coordination differently than one who's been skeptical of the sector. So from that perspective, we can expect better and more from him. Now, this is where we zoom in. Now, the fifth factor relates to what just happened in the markets. Gold fell 9% in a single day, its worst performance since 1983. And silver dropped 31%, the worst day since 1980. And Bitcoin declined from $84,000 to the mid $70,000 range. But when you look at the setup, okay, you zoom out and you look at the setup before this move, there are some important details that could have foreshadowed this crash because we saw that gold had appreciated 65% since last year and silver had gained 145%. Tell me yes or no if they were not overinflated and signaling a top, because these were significant runs and positioning in these assets had become quite crowded, meaning many investors held similar positions, often with leverage. So, when the Warsh nomination was announced, the narrative in the markets shifted, and very fast. The thinking went from Warsh has Fed experience, markets will trust him, dollar debasement fears were overblown, don't need safe haven assets. So this thinking triggered selling, which triggered margin calls, which triggered more selling. That's a liquidation cascade. And it was particularly pronounced because it happened over a weekend when market liquidity is thinner. But here is what is relevant. And here's the question. Did the fundamental reasons people were buying gold and Bitcoin actually change? No, they didn't. Government levels didn't decrease, geopolitical tensions didn't resolve, and the AI infrastructure build-out didn't get canceled. The $2,000 dividend commitment wasn't walked back. They're all still standing. Professional analysts at firms like JP Morgan and WisdomTree have noted they're maintaining longer-term bullish views on these assets. They're characterizing this as a correction within a larger trend rather than a trend reversal. This distinction matters. Technical selling, driven by positioning and leverage, is different from fundamental deterioration. Bitcoin is now about 40% below its all-time high of $126,000, and gold is roughly 13% below its recent peak. When fundamental drivers remain intact, but prices decline due to technical factors, that creates a different risk-reward dynamic than if the fundamentals themselves had weakened, which they haven't. Now let me tie everything together. We have 5 separate factors, each pointing in a similar direction. First, AI infrastructure development is a stated national security priority requiring significant capital investment, and our government has the ability to print money. Second, there are political commitments for fiscal programs timed before the midterm elections, which would be more feasible in a lower rate environment. Third, the nominee for Fed chair recently made public statements advocating for lower interest rates, while also investing in crypto-related companies himself. So what do you think he's going to do? Fourth, regulatory framework for cryptocurrency is being actively developed, with key meetings happening this week and legislation advancing in the Senate. Fifth, the recent market decline appears to have been driven by technical factors and positioning rather than changes to underlying fundamentals. Those are intact and just as powerful as ever. So when we look at all these factors together, we lay them out on the table. They suggest that interest rates are more likely to decline than increase over the next coming months. But let me be clear, this analysis that I painted out for you here could be wrong for several reasons. And I find it to be my responsibility to tell you why. Warsh might prove to be more hawkish than his recent statements suggest. Maybe he was just saying them because he wants to get nominated. I don't know. But he's invested in crypto companies in early stage himself, which he didn't make up. However, inflation could reaccelerate, forcing the Fed to maintain higher rates. Next, the Supreme Court could invalidate tariffs, removing the funding mechanism for dividend payments, okay? Unlikely, but it could happen. What else? Geopolitical events could change the entire calculus. We don't know what's going to happen in politics or globally, but based on what we can observe right now, the policy commitments, political incentives, regulatory developments, and stated positions from key decision makers, the path of least resistance appears towards monetary accommodation rather than continued tightening. And for Bitcoin and crypto assets more broadly, this would be a supportive environment. Lower rates typically benefit risk assets. Regulatory clarity removes uncertainty, markets like that. And having a Fed chair with actual experience, as I was saying, investing in this sector is materially different from the previous status quo. At least we won't have a Fed chair who's ignorant and ignorantly resistant to crypto. So that's the case as I see it. It's not a guarantee, as I said, but a reasonable high probability scenario based on observable factors. But of course, do your own research. Manage your own risk appropriately. Your finances are not the same as your buddies or those people you see on X. And understand the forces at play so you know how to hedge and protect yourself against them. And I am not a fan of using leverage ever. I'm just a believer in Bitcoin ultimately going up to $1 million plus someday, and that's it. So I hodl. And when altcoin season rolls around, when it does, as I believe it will, I will be investing or betting or gambling on some more risky beta plays, which I will share with you if you want. I may start a separate channel or do this on social media, but I will also always let you know why I'm investing in them or gambling in them and what the risk profile is. But separate topic for separate times. But all right, that's the case for today. Those are the 5 reasons why I believe liquidity has to increase in the very near future. The 5 reasons why this whole Warsh thing might actually be bullish. Let me know what you think. Let me know, am I completely off base here? Did I miss something? Let me know in the comments section. I actually read your comments and I love hearing from you guys. And of course, if you found today's video valuable, like the video. It means so much to me. You have no idea. I count every single like, every single subscription. It really encourages me to keep coming to you day in and day out because I do put a ton of work into every single video, and I will continue to improve and offer you guys more and more resources as I do. Thanks for watching, and I'll catch you guys in my video tomorrow.